Hello, welcome to the Economic View. I'm joined by our Chief Market Strategist, Evan Lucas. Hi, Evan.
Hey, Tony, how are you?
Very good. Big day today, big day a couple of days ago with current account figures, but today's GDP. So we've got a real snapshot now of what's going on in the economy.
Yep, and as sort of you and I have been discussing and what we've been sort of forecasting is that Q1 was going to be really strong, and it was. So quarter on quarter, 1% beat expectations by 20 basis points. Year on year, 3.1%. That's a very good figure. Beat consensus of 2.8. There was only two economists out there out of the 27 surveyed by Bloomberg that forecasted a GDP figure on a year-on-year basis above that. What you really want to look at, and I think what we need to talk about, is inside it and what comes with it.
Yeah, and I wanted to do that. What struck me both with these GDP figures and with the current account figures is the growth in exports and what's happening there. And a large part of that's coming out of mining from what I can see. So let's talk about that.
Yeah, so I think that I deliberately want to make sure we get this completely dead on. So exports, goods and services rose by 2.4%. Exports for year on year and for services is now 4.6%. So really, really solid, as you alluded to. Yes, it's driven by mining, liquefied natural gas, coal, iron ore, but it's also driven by non-rural exports. So we saw that up by 3.3. So that's things like education, tourism, health, etc. Things that we talk about that don't always get picked up in surveys, things like the capital account expenditure numbers, etc. They're also a major reason why exports were astounding. And what I've got on screen for you now is to show you the contributions from Q4 compared to Q1, and you can see that drive in that big net export mover.
Yeah, what I saw in the numbers too is that in terms of exports, as you're saying, iron ore, coal, etc., that's really feeding out of strong demand. Obviously, our major trading partner being China, but strong demand really for these commodities is not abating. And a lot has been said in the past about the end of the mining boom. Yes, we have seen the end of the mining boom as we knew it then.
Yep.
But there's still a lot going on in the mining sector.
Yeah. So the difference between what we call the mining boom and now is that the mining boom also included a whole range of expenditure on actual the production of. So we all hear about the collapse of the mining expenditure space, and you saw that in these numbers again, and we'll come to that in a sec. But you're right. The other side of that is the operation side of it is powering ahead. So the demand from China is there. We know about the iron ore story. You saw inventories coming out of Port Hedland at the end of last week and then also out of Broome this week that showed that the demand is very much there, which is a real positive sign. You also, inside of those numbers, you can also look at the fact that not only is demand there, that the average price was better than forecasted at this time in the cycle as well, which is again another lead to it, and why you've got such a real big driver. And that gets back to your question about the current account at the start of this, is that the current account narrowed right in on Monday. Really, really positive level we haven't seen in about 6 years, and we now have an account deficit of $1 billion, and that's fantastic. That really shows that there is some serious money coming into the coffers.
Yeah. So where we are in the financial year now, we're into June, heading rapidly towards the end of the financial year. Is this a trend that you're going to expect to see continue?
Yeah, good question. Q2 in Australian standards, not overseas because it's Northern Hemisphere, but Southern Hemisphere, we tend to slow down a little bit. Seasonality comes into that. What was really interesting from the Q1 numbers that will likely start to feed into Q2. The disappointing stuff everybody will point to is consumption. It does make up 60% of GDP. Still expanded, and I think that needs to be put out there. You will see the cynics really trying to highlight this as a problem. They'll also highlight that per capita things are a little bit weak. What was very interesting, and again, getting back to the insider, is the compensation of employees. It grew at the strongest rate since June 2012, particularly in health and particularly in construction. And that I think needs to be really sort of signaled out there. The increase over the year is now 5.1%. So this is wages. So getting back to your question around what happens in the second quarter of the year, consumption has a lot of scope to the upside. Now, retail sales have been, minuscule, probably a little bit mute, but we saw in April, they snapped out of that. and we've also seen that continue through into May. So consumption's where that could happen. Net exports should continue. We know that the demand has been there. Price has also been on the upside. So liquefied natural gas was good in Q1. However, since then, oil prices in Q2 have been really, really strong. Highest they've been in about 3 to 6 years, but whether you look at WTI or Brent, and the natural oil price, gas price is under that. So that should also give a value kick to net exports because they may fall away a little bit slightly. But overall, Q1, Q2, and probably most of Q3 should be pretty good. Back end of the year may slow down. Everybody's forecasting 2019 and 20 to get a little bit slower. The US is tightening. What happened today should get the RBI excited, and there may actually be talk, not action, but talk around where the economy sits. But you can't go past very solid headline numbers.
Yeah, I was going to get to that, and perhaps we can talk about it next time in more detail, but really, how does this stronger than expected economic growth flow into things such as interest rates and inflation, etc.?
Yeah, and look, very quickly on that, inflation still has got a long way to go. So we've still got slack in the employment market, we've still got slack in consumption. So they're the big ones that really feed into inflation, and the RBA themselves don't believe that inflation of their mandates, the underlying core stuff, will be touched till 2020. So interest rates are still a bit way off. What you may start to hear is more optimism. I mean, they're already optimistic as it is, but more optimism again, and just warning about the risks that come with having to slow down the economy. So that may be more of it, but there are enough levers out there doing it naturally for them. The Aussie dollar has gone back to 76 cents, and that will slow the net export boom that we've been getting in the first quarter down because the amount of repatriation isn't as good. You've also got a scenario where if that's also the case, the consumption of other exports, education, health, and also tourism, as I said before, also drops off a bit. So the macroprudential rules, we know about that, and I'm sure you've seen in the housing market with Sydney and Melbourne. So there are natural reasons why the RBA doesn't have to move either direction because the market is taking care of itself. So it will be there, but it won't be as a booming call to see interest rate moves.
All right, Evan, thanks very much again.
Thanks, Tony.
Join us again next time on Economic View.